My name's Christine and I'm a tutor on Chegg Tutors. Today we'll be discussing required reserves. Before we can get to required reserves, we have to understand what reserves are. And to understand what reserves are, we have to look at a balance sheet for a bank. Right here I put up a balance sheet on the screen that shows assets on one side, liabilities and net worth on the other. You might also see net worth referred to as bank capital. They're the same thing. Now, important for reserves is to understand that cash and loans are on the asset side, whereas liabilities are on our checking deposits. Why might checking deposits be a liability to a bank? Well, when you give a bank money to hold in your bank account, what they're giving you is a promise to give you your money back. So that cash becomes an asset to the bank because they get to hold on to it, whereas the promise to pay you back is a liability. For a bank, having that money on hand is a profit-making potential. Why? Because the bank can take the money that you gave them and they can loan it out to other people and earn an interest rate. On the other hand, a bank can't loan out all of the money that you give it because it needs to have money on hand to meet checking deposit demands. In other words, if it loaned out all of its money and you wanted to withdraw some money from the ATM, it wouldn't have any money to give you. That would be a bad thing for a bank. So a bank has to hold some cash on hand in order to meet checking deposit withdrawal demands. We call cash reserves when it's with a bank. You'll see that I put reserves in parentheses. So a bank reserves is also just the cash that they have on hand. It might also be referred to as cash in the vault or vault cash. In order to meet the reserve requirement, a bank has to hold enough reserves. Now, what is the reserve requirement? Well, the reserve requirement is just a ratio that the bank is required to hold. But what might that ratio be? So, if we look, we see that the required reserves is a ratio of reserves to deposits that a bank is legally required to hold. In other words, whatever that ratio is the number of reserves that they have to hold as a proportion of checking deposits. So, for instance, the Federal Reserve is the one responsible for setting the reserve requirement. If the Federal Reserve sets the reserve ratio to 10% or 0.10, then a bank has to hold 10% of all of its checking deposits. So, going back to our balance sheet, if we assign values to checking deposits, let's just say that there are 1 million checking deposits. In the reserve ratio, we can write that down as 0.10, meaning they have to hold 10% of all checking deposits as reserves. In order for them to be in compliance with the law, they would have to hold 10% of 1 million, or 100,000. If they have 100,000, they have met their required reserves. And again, these required reserves are there to ensure that a bank can meet all of the checking deposit withdrawal liability. So when you go to your bank and you want to withdraw money, they have the money and the cash on hand to be able to meet that liability. A bank then will loan out all the money that is not in their required reserves. So a bank's loans outstanding would be $900,000. Now, a bank doesn't have to hold just the required reserve. If a bank wants to, it can hold more cash and therefore have more reserves. If a bank holds more, in this example, than $100,000 in reserves, it is then holding excess reserves. So for instance, if I go ahead and I change that number to 200,000, that means loans have to be 800,000. And if loans are 800,000, then they're holding 100,000 extra in cash. And what that means is that they're actually holding excess reserves of 10%. For total reserves of 20%. I hope that helps explain what required reserves are.